Welcome to the second quarter Earth Equity Advisors client webinar. Obviously, I'm not in my office if you're watching on video here. We are actually on vacation this week, but I decided that we needed to make sure to chat with everybody. And so I'm just taking an hour or so off from enjoying some time at the lake here. But anyways, without further ado, let's get started here as I share my screen. All right, there we go. Resize here quickly. There we go. All right, of course, we have to go through our normal disclaimers. And our agenda is going to be very similar to what it was last quarter. Last quarter, I gave a bit of an abbreviated webinar and gave more time for Q&A. I decided that that would be a good idea this quarter as well, considering so much flux in terms of tariffs and just the upheaval and stuff that's going on with that, the big beautiful bill, etc. So we'll give an update, talk about markets and economics, get into fund performance, some of the changes we may have made last quarter, and of course a good Q&A. So just a very brief update. This past quarter, I was in Kansas City back in April. Seems like forever ago, but for our Prime Week, so that's Prime Capital Financial's annual conference, and enjoyed seeing everybody there and spending time with everybody from other advisors to the folks who run Prime. We also had what's called Most Summit in Asheville, and it's a summit of different impact kind of companies and such. And it's something that several years ago, when it initially started, I had a hand in getting it up and running. So it's great to have it back in Asheville this year. We rebalanced the Green Sage portfolio on June 1st. And we rebalanced our fund portfolios on July 1st. So those have both been taken care of, and I will get into especially the fund portfolios a little bit later here. For those of you who have been asking, the Sustainable Investor is complete. It is with the publisher right now. In fact, I've got a couple of emails that I need to follow up on. But anybody who's interested in pre-ordering, you can use the QR code and get your very own copy. It will be coming out. They're telling me the end of October, maybe early November. So anybody who's interested in my first book, The Sustainable Investor, would love to have you pick up a copy. And I think I said this in the last quarter as well. We are actively hiring new financial advisors in Asheville and in areas around the country. So if you've got somebody you know who is a financial advisor who would be interested in working with us as a sustainable financial advisor, please put them in touch with me. So we celebrated our 20th anniversary celebration. Our 20th anniversary was actually last year, and we were going to have a celebration at the end of the year, but Hurricane Helene put a pretty major damper on that. So earlier this year, I believe at the end of May, we gathered at Ginger's Revenge, which is a local ginger beer brewery in Asheville. And it was great. We had a number of people from Prime Capital who traveled to spend time with us. And we also had a lot of clients and friends over at the event. So we were so happy to see everybody. Here's the team. Lisa came out of retirement to come and spend some time with us as well. Unfortunately, Rebecca was sick, so she couldn't join us for the team photo here, but we had a great time. We had people from my friend Randy Talley is there, the person who sort of inspired the Green Sage portfolio was there. Local friends, politicians, musicians, clients, etc. We had a really good time, and thanks to everybody who came out. And unfortunately, sorry for those of you who missed us. Maybe we will see you again. Let's do it again in 5 years. How's that sound? All right, let's get into serious business here. So these are the quarterly returns here for the second quarter of 2025. Interestingly, And this is something that we saw back during the first Trump administration, actually, when clean energy actually performed rather well. And we saw it this past quarter as well with clean energy using the iShares iClean ETF as a gauge, up over 16%, which was the best performer during the quarter. Everything was up though across the board, from international shares to the S&P 500, emerging markets, bonds, etc., small caps. Of course, when we take this out to a year, the clean energy hasn't performed. Our bigger performers, of course, are all cap world index. So basically global stocks. What else do we have here? Small caps. We've also got emerging markets. So a number of different areas performed well. And this takes us out for the 5 year. Domestic stocks, S&P 500 is the big gainer there over the last 5 years. And over 10 years, it's the same thing. So large cap US stocks have continued to be the best performer in general, with global stocks coming in second. And when we look at the valuation of the S&P 500 over, the last quarter or so, we've jumped up to, quite a bit higher than we were last quarter. We're still, we're greater than one standard deviation above the 30-year average at about 22 times earnings, 30-year average being at 17. So we are a little bit on the overvalued side, but as you can see, we've been there before, and we just continue to move back and forth, going back to 2020. So, we'll see what happens. But profit margins, in the S&P 500 continue to go up. This goes back to 2002. So you can see the upward trend in profit margins for S&P 500 companies that would lend to a higher multiple being acceptable. But one of the things to remember is that in the S&P 500, when you're looking at it, it's a weighted average. It is a weighted benchmark. And so the bigger companies have a much bigger influence on that index. And so, the top 10 are 38% of the index, and they're bringing in about 32% of the earnings. So they really vastly outweigh what's going on of the other 490 stocks. I talk about this just about every quarter, but I think it's important to remember that it's not necessarily a direct indicator of how the market in general is doing. It's a really big indicator of how the biggest companies are doing. And when we look at the price to earnings ratio, the multiple of the top 10 stocks, you see in green that it's right now about 28.8. The other 490 stocks, it's about 20. So they are also trading higher than average. However, they're also trading at a more reasonable multiple. I've talked about AI multiple times here, and we see that AI continues to be a big investment with pretty much companies across the board. But right here, these are what they call the hyperscalers, which is Alphabet or Google, Amazon Web Services, Meta, and Microsoft. The amount of money that's being spent on this right now is, I don't want to use the word obscene, but the amount of money is crazy. And it's interesting when we look at in actual dollars, but also percentage of operating cash flow. It is a major, major portion going forward into 25, 26, 27 as a percentage of operating cash flow, almost to 100%, as you can see on the right-hand side here. So numbers are continuing to go up in terms of investment, and it's across the board in terms of the kinds of companies, everything from actual information technology to finance and insurance and real estate, and on down the line here, as you can see. In terms of inflation, June, we saw something start to pop up again. So we saw, I mean, it looks marginal here right at the end, jumped up to 2.7% from 2.4. So, that's still a 10% increase over the previous month. And it sort of breaks that downward trend going back to June of 2022. Doesn't necessarily mean that things are going to continue to go up, but there are, questions being asked. And, the tariffs are, probably a likely cause for it. This is from a New York Times article last week. CPI rose 2.7 from a year earlier, and the experts, the economists are basically saying that the tariffs have pushed up prices. Um, I thought this was from an article the same day. You know, the economy seems healthy. Were the warnings about tariffs overblown? Well, maybe they were, maybe they weren't. But this will take time to play out, especially with some of the deadlines that we've got coming up over the ensuing weeks here. Big question is, will the Fed lower rates? There was some talk last week about efforts to maybe push the Fed chair out. That has since been tamped down some. You know, there's a lot of wrangling going on right now about who's going to replace the Fed chair coming up next year, and a lot of those folks are talking about how they would start lowering rates right now. So it's interesting how they're playing the political game because we know that's what the president wants at this point to lower rates. While most of the Fed governors are like, let's just continue to wait and see. So we'll see what happens in terms of lowering rates. We've really tried to position our portfolios, both our fund portfolios, but also custom portfolios where we bought individual bonds for folks to really take advantage of lower rates as they do start to come back down. When we look at imports by country, we see how China, going back to, the mid, 2014, 2015, 16, et cetera, was, well over 20% of imports, and has dropped tremendously down into what's that, about 7.5% or so, while at the same time, the Euro area, Mexico, has gone up. But ironically too, we see Canada has continued to drop. So when we think about from even just from a climate and an energy use perspective, having trading partners that are close by, so we don't have to ship across oceans, don't have to ship very far. It would make a lot more sense for us to be a bigger trading partner with Canada, a bigger trading partner with Mexico, which we do see going up here. Um, India is sort of the outlier here. We see them just slowly starting to move up as they become a powerhouse. They've got, if not the largest, one of the two largest populations in the world at this point. Taiwan and South Korea, and other Asian countries really looks like they're overtaking China in terms of their share of China trade. When we look at mining production by location, so just about every electronics um, device that we have has got rare earth minerals in it, be it, from nickel, cobalt, lithium, etc. A lot of that is going into the batteries that we use either in our phones or our cars or our computers or whatever it is. And we see that the vast majority of those are, not coming from here in the United States. And so, that's something to keep in mind when we talk about tariffs and the potential for added inflation. And when we look at semiconductor production as well, we've got right now, where is it, right around 11, 12%, give or take. It shows us growing somewhat, but the reality is that our semiconductors, which are in, again, just about every single device that we have, are being produced elsewhere. And it truly is, what that tells me is that we truly are in a global economy. When we look at sector revenue and a percentage of foreign sales, again, this is related back to tariffs as well. Utilities, we're not selling much electric overseas, but we are selling a whole lot of technology overseas. We're selling a lot of materials, commercial services, staples, etc. In general, the S&P 500, when that's balanced out, 40% of the sales in the first quarter of 2025 were sales external to the US. And so again, if we start to see tariffs coming back on us because of the tariffs that we have laid out, it's probably going to hurt. It's probably going to hurt U.S. companies. And once again, when we look at the tariff rate that really is in place here, historically speaking, it is, we're going back 100 years, well over 100 years since we've seen these level of tariffs. Uh, Columbia Business School took a look at the so-called Big Beautiful Bill and really looked at some of the Inflation Reduction Act incentives focused on renewables and things. And there's a lot of data here. I'm not necessarily going to get into it all, but I wanted to focus on just a couple things here. Number one is that utility scale solar and wind are now cheaper than fossil fuels. Battery costs aren't far behind. And so the reality is that train has left the station. And no matter what anybody tries to do to really get in the way of renewables, it might slow that train down some. But because the prices have become so low, you know, irrespective of any of the um, incentives, that we are still going to continue to see a build out of our clean energy infrastructure. And one of the things that Columbia Business School really pointed out with the One Big Beautiful Bill is that the big winner ultimately ends up being China. That, in 2024, $2.1 trillion went into the energy transition. I think I talked about that either the last quarter or the quarter before. No, it would have been last quarter. 40% of the total, which is more than the US, which 818 billion of that was China. Um, which is more than the US, EU, and UK combined. And so that says a lot about what they're doing. They're going to continue to develop their clean energy infrastructure, and they're going to continue to export that clean energy infrastructure. And I think the last line here, the global clean energy transition will continue, leaving the United States further behind. And so we will do our best as investors to make sure that we're investing where we're going to make the biggest impact. But we have had to make adjustments in general to how we invest in the clean energy sector. One thing related to the big beautiful bill and how we look at taxes. We look at capital gains and dividends rates going back to 1954, and dividend rates, you see your dividend tax rates, you see just a chart that goes, down and down and down. Likewise, households effective federal tax rate continues to go down and down. And when you look at the tax rate in the U.S., we are one of the lowest taxed developed nations. And ironically, as we still want a lot of the services that are paid for by taxes, but don't necessarily want to pay the taxes to provide those services. And ultimately, what we end up seeing is our debt as a percentage of GDP will continue to grow. Right now, based as of 2024, the U.S. is 121% of GDP, and that will continue to grow. A safe bet is typically under 100%. That is going to go up with some of these tax cuts, unfortunately. And when we look at federal net debt, or accumulated debt, again, that continues to go up well over 120% of GDP. So how are we handling all this sort of craziness that's going on here? Not a whole lot different than last quarter. And I think we did some of the moves we made last quarter, ended up really well. Um, so we rebalanced Green Sage, which always remains fully invested on June 1st. And some of the moves we made in there, again, were based on knowing what the current environment is, especially in clean energy. But we actually started moving out of some of our the more volatile sectors there in December on December 1st when we rebalanced the portfolio then. We rebalanced our fund portfolios on June 1st, which is where the vast majority of our client assets are. We maintained a reduced domestic allocation, and we maintained an increased allocation in international. And that's actually, well, I'll show you how those funds have performed in just a second here. Maintained our allocation to fixed income. We added a sustainable commodities fund, just a very, very small allocation. Um, but one of the funds that we have in there, one of our alternatives, changed the way they invest. And even though it's been a good performer in general, it doesn't necessarily fit our investment thesis. And so we're going to be wrapping ourselves or moving out of that particular fund over the next. We took about half of it out this last quarter. We'll probably take the second half out at the end of next quarter and move on to a different fund that has a similar style of investing, but we'll stick more to what our investment thesis is. Of all of our portfolios, our Green Sage, and then our four fund portfolios, you can see the mix that we have of stocks, bonds, and alternatives. And the number at the bottom is the risk level. So with 100 being the absolute most volatile, risky portfolio, and with zero being, for lack of a better word, burying the money in your backyard, which has its own risks because of inflation and things like that. You can see where all of our funds or our portfolios lie. Obviously, Green Sage is going to be the most aggressive. And then on down to conservative, which has a much lower allocation in stocks, much higher allocation in bonds, and obviously alternatives, as you can see, is about the same for all four of the fund portfolios. And when we look at this chart from JP Morgan, we see that when we balance out volatility, which is the horizontal axis, with returns, which is the vertical axis here, when we use stocks, bonds, and alternatives in a sort of a balanced way, it gives us sort of the best combination, the best ratio of returns to volatility. And that's really where we try to focus those fund portfolios on, is reducing volatility while maximizing return as best as we can. So equity fund performance was a nice rebound from Q1. Q1 was a very difficult quarter for us, for everybody. Long-term performance continues to be in line with what our expectations are and the risk models that we've put together. It was good to see clean economy stocks bounced back in the quarter, as well as infrastructure did well too. As always, we'll make tactical changes mid-cycle if it is warranted. But for the most part, we're going to rebalance our fund portfolios on a quarterly basis. So I was able to actually break this down a little bit here and show you. So for example, the two funds that we have that are benchmarked by the S&P 500, the Brown Advisors Sustainable Growth Fund and the Parnassus Core Equity, I can highlight these here. It's a little easier to highlight. And when we look on the 1 year, we've done well. I'm sorry, the quarter we've done well. When we look on the 5 year, we've done okay relative to it. But when we really take this out for the long term, 10 years in inception, the funds that we're using have done really well relative to their benchmark. We use the Green Alpha portfolio, which is truly a sustainable manager, a global sustainable manager. They've actually been around longer than 10 years, but they changed the way they invest. They went from a mutual fund to an ETF a year and a half, 2 years ago, maybe a little longer than that. So that's a little harder to look at their longer term comps here. But let's go into small caps. This quarter we haven't performed well, but when we look at the 1 year, when we look at the 5 year, when we look at the 10 year, very happy with the numbers of our manager here. When we look at international, our Janus Henderson fund has done exceptionally well relative to its benchmark over this time. And when we look at emerging markets from Calvert, it's done exceptionally well relative to its benchmark. Two others that I'd like to point out for you as well is we use the First Trust Clean Edge Smart Grid Infrastructure, which is a mouthful, I know, but it's performed exceptionally well this year, in the quarter especially, up 23%. Over the year, it's been 21. But when you look at this, 5 years at 20, almost 22, 10 years at 16, we switched into this fund, I want to say about a year and a half ago, because it was performing well and it really hit the kinds of companies that we wanted to own that really are focused on the energy transition. And then secondarily, the infrastructure fund. A lot of you have heard me talk about our new definition of SRI as sustainable, resilient, and innovation investing, with the resiliency being a focus on infrastructure and those areas especially that failed during the hurricane in Asheville. utility infrastructure, communications infrastructure, and transportation infrastructure. This portfolio has done, really well, again, at both the quarter, the year, 5 years, etc. So we're happy with our equity fund performance. When we look at the bond side, um, I don't have direct comps to necessarily show you, but we can look through each of the funds that we use. PIMCO's climate bond in the quarter has beaten the aggregate bond. Aggregate bond is just basically an index of all the bonds put together. Pretty much everything except our private credit and our community access capital fund outperformed the aggregate bond index. One thing I want to say is on the Access Community Capital Investment from RBC. I think I told you all last quarter that we have an opportunity to actually direct the monies that are in this fund into the counties that were impacted by Helene. We literally just got the report in on Friday, so I didn't have a chance to integrate it into this presentation, but I can actually see where the money went to, that it went to low-income housing, mortgages in several counties around Western North Carolina. Next quarter, I'll be able to actually show you what the numbers look like. Our alternative portfolios or alternative funds in here, we can see that they have also performed well, especially over the 1 year period here. Their job, as I've told you before, is to be non-correlated. Their job is to move in a different cycle than both the stock and the bond market. So when we have more volatility, they're meant to sort of buffer that volatility. Um, Different asset class returns here. This goes back to 2010. But when we look at everything from large cap companies, small cap, international, emerging markets, etc., when we put a portfolio together, it's always going to be a blend of that, an asset allocation, as you can see. Year to date, in general, it's about 7%. And that's close to about where our balanced portfolio is, give or take. And so we're happy with that. Um, I want to stress the importance of long-term investing because a lot of times we'll think when markets go down that the world is ending, and we saw that, on Black Monday, and we saw that during the tech boom and the tech crash in 2000. We saw that during the financial crisis, and we saw that during COVID. But when we look at the long-term trends of the market, these events sort of turn into blips. And we see over time that the markets move up. And again, past performance isn't indicative of future results, but this goes back to 1900, and we can see what markets have done over that time. This is always a chart that I use in this presentation, but it's so important, the concept of time in the market versus timing the market. When we look again at the investment from January of 2003 through December of 2022, if you had been invested in the S&P that entire time, 10,000 turned into 64,000, almost 65. If you had missed just 7 of the 10 best days, or if you missed the 10 best days, you halved your return, and you can see how it goes down over time there. So being in the market is the most important thing. So we're going to continue to keep a close eye on the economy as we always do, especially U.S. and international politics, things that are potentially can affect portfolios, and make adjustments if necessary. Um, Make tactical changes, like I say here. Uh, we are so grateful for your business, your friendship, your introductions. We're regularly getting introductions to family members and friends. Thank you so much for that. That means a lot to us. I wanted to take just a moment and say thank you and goodbye to Carrie. Carrie is moving on to other opportunities. I grabbed this photo, and partly because I'm younger in it, but this is when she graduated from Leadership Asheville with Neil and I. And so again, just wanted to say thank you for all her contributions to Earth Equity, and wish her absolutely the best of luck in the future. And with that, I am going to switch over to Q&A here. So let's look and see if we have any questions here. What is the projected impact of AI on sustainable investing? My definition of sustainable investing is investing in solutions for the future, investing in solutions to our greatest challenges. And so I think that AI is a tool. Let me backtrack a little bit here. So Melissa, my wife, is a teacher in or a professor in Warren Wilson's climate, let's see, Masters of Applied Climate Studies program. And she had a number of students there on campus a few weeks ago. And she talked about AI a little bit with some of these students, and a lot of the students were very resistant to it. And she and I had had conversations about this prior to the class about the importance of AI as a tool because ultimately it's going to change how we educate. It's going to because assignments that students may have had, it's much easier to go to ChatGPT or whatever platform you're using and get all the answers. And so um, we need to look at, I think, AI as a tool. I've been a strong proponent of AI in drug discovery because the amount of iterations that you can use AI for in silico versus the amount of time it's going to take in situ is just potentially having the time, potentially having the amount of money it takes to bring a drug to market is tremendous in terms of its opportunity to have an impact. So I continue to use it as a tool. I don't think it's going to replace me. At least I hope it's not going to replace me. But I do use it as a tool. I do have a piece of software that helps to analyze what portfolios look like by actually looking back to see, using different types of metrics for stocks and how we can create portfolios looking back, but also using those same metrics looking forward. Any other questions? Go to the Q&A on your Zoom. Put some more questions in for me, please, while you've got me here. Well, if nobody has any questions, I will wrap us up. A little quicker than we normally do, so I'll give you back a little bit more of your day today. If any questions or any issues or anything else comes up, once we wrap up here, please don't hesitate to reach out to myself or Neil. One of the things I'd like to encourage everybody to do is because Neil and I are taking on a few extra clients each, when you need to reach out to us, please reach out to the client service email, which is just client service at Earth Equity, and allow Sylvia and Rebecca to be able to sort of work our calendars a little bit. It'll make life a little easier for you. It'll make life a little easier for us as we work on scheduling and different things like that. She's been tremendous. Rebecca's been tremendously helpful as we've gone through this transition of Carrie stepping away and Neil and I helping out some clients that we've had in the past and some clients that we haven't had. So we're really excited to see where we take Earth Equity from here. We're hiring, and you know we are very excited about the future. So again, thank you everybody for joining us today, and we'll see you again next quarter. Take care.